Good afternoon. My name is Julia Coakley. I'm the Chief Operating Officer at the MGAA, and I'd like to welcome you today on behalf of the MGAA to our briefing this afternoon, which is being delivered by the Financial Services Compensation Scheme. Before handing over to our presenters today, I'd just like to run through a few housekeeping points. Please ensure for the moment that your cameras and microphone is off. And if you would like to ask a question, do use the chat button at the bottom of your screen. The questions will be answered during the Q&A session. Your question will remain anonymous. However, if we do not get time to answer your question, if you'd like to provide your contact details to one of the MGA exec team, the chaps Josh and Guy, who are kindly presenting today, will be happy to answer your questions post-event. The MGAA's Programme of Learning and Insights has been accredited by the Chartered Insurance Institute for the quality of content and supporting materials, with CPD hours applicable if this is relevant to your ongoing professional development. The recording of this briefing will be available on our website and our MGAA YouTube channel. Finally, you will be sent a survey to provide your feedback on this market briefing, and we really do appreciate your time in completing this because it does allow us to ensure that we are delivering the best quality events to our MGAA members. So today's briefing, FSCS, Recoveries and 2023-24 in review, is being delivered by Josh Rendall, Stakeholder and Public Affairs Manager, and Guy Enright, Recoveries Finance Manager. Josh joined the FSCS in 2019, previously working for Hume Brophy, now Penta, leading aviation clients, especially with the US airline industry, with their public affairs and campaigns for a new Open Skies agreement post-Brexit. Josh studied law at university and undertook his subsequent legal training in Cambodia. He is also a councillor in Kensington and Chelsea and has been on the council cabinet since 2020. Josh currently leads the Adult Social Care and Public Health Department. Guy is a chartered accountant, leading the finance team's input into the recoveries function, which seeks to get money back where compensation has been paid and reduces the cost of FSCS to the industry. Guy's role includes regular reporting, budgeting and forecasting, and ad hoc advice on the actual and potential financial impact of failure of firms to FSCS. Guy has extensive experience in insolvency and restructuring, particularly to the financial services industry. So Josh, if I might hand over to you.
Thank you, Julia, and thank you all MGA members for dialing in today. As Julia wonderfully said, my name is Josh, and here with my colleague Guy, we're going to take you through some things about FSCS. I won't go through that, but Julia's done that very helpfully, and how we operate as an organisation, how we pay compensation, a bit of history around the levy, how we do claims, and then of course talk about the recoveries process. There are some learning objectives for everyone dialing in today and those dialing from home afterwards to watch on recording. And that's things, hopefully you will have a better understanding of FSCS, summarize the rules that govern us and what we cover, explain compensation payments and levy classes, and then outline the recovery process as well. So that's kind of what we're going to speak about to everyone today. There are about 15 minutes or so of questions at the end, and we're really happy to take those, as Julia said, either now or in writing subsequently to the presentation, if people have a thought later on or whatnot. So I hope that's helpful. So we'll do an early kind of FSCS 101. It probably reminds everyone of university days on how this happens and how this works, but we'll take you through a quick brief of that. So overall, FSCS is established by Parliament. We were set up in 2001, where we combined about 6 or 7 previous compensation schemes into one. And from that, we are regulated by now 2 major regulators. That is the FCA and the PRA, as everyone probably is well versed on. And both those regulators set out rules. So that is how we pay compensation and when we do it. In consultation with FSCS, but they also operate the levy class limit of FSCS as well. So how much compensation we can pay out per activity we cover. Now, the interesting thing about FSCS is that we cover the largest amount of activities probably in the world. compared to our other colleagues in deposit protection or insurance protection. Our probably closest other colleague would be in Korea, actually, in their KDIC and what they cover in terms of their activities. But as you can see here on the screen, what is regulated by the FCA and what is regulated by the PRA, basically what FSCS covers. We won't go through them individually. You can read them on the screen. But our most interesting one, for example, is we cover advice. So many countries in the world don't actually cover advice at all. They cover the activity in of itself if that fails. But that's one of the things that FSCS covers that kind of makes protection and confidence in the UK financial services industry, I think, really quite strong. We recently, last year, have taken on funeral plans, which is our newest piece of coverage. We do, again, up to £85,000 if any of those funeral plan providers were to fail. But probably our most famous protection we cover is, of course, bank and building society credit union failures. And they work slightly differently to the rest, which we'll go into later on. But everyone who has a bank account, no doubt everyone on this call can be rest assured that all your money is protected up to £85,000. Go through. So I thought we'd give a start of a 10 on kind of what we do in terms of claims and new claims as a bit of an introduction. So as you can see here, these are the claims that FSCS has paid out from the raising of our levy, which we'll go into later on as well, to particular classes of failures. Now, you're probably looking at the screen thinking, oh my God, insurance, that is covering 83% of the entire coverage of FSCS in the last 5 years. How does that impact me? How does it impact my organization, the people I advise, et cetera, et cetera. Somewhat so that this is slightly askew in a way, because even though insurance has the biggest percentage on the screens and not exactly kind of how it potentially looks. So for most claims that FSCS processes, such as advice or deposits, that would mean we'll be paying out a particular amount, depending on obviously how much a person has lost up to the limit, to those particular individuals. With insurance, as many people on the call may know, it's a bit different at FSCS. So instead of refunding or returning the insurance premium, we will seek out another insurance provider to take on those claims if another insurer has failed. So we're not physically paying out money per se in that regard. What you can probably see here, which makes up the majority of these claims, is the failure of MCE, which was a third-party motor insurer. That resulted in about 100,000 people having to seek new insurance premiums. And FSCS kind of helped and facilitated in that particular regard. We do have one or two occasions where an insurance provider has failed and we can't take on another provider cannot take on the claims of that particular failure. FSCS will step in and make those premium payments, insurance claims, if and when one does occur, but they're extremely rare. And for the most part, when an insurer does fail, FSCS will find a new insurance provider. So as you can see here, slightly skewed, but in terms of raw figures, basically kind of that's what it looks like day to day. But as I said, nothing to particularly concern about in terms of paying out a particular premium or having increased levy costs perhaps for your particular class. As you will see here, we've got an interesting kind of table, and this again reflects kind of the payments we pay out in terms of our compensation. Now, over the past few years, FSCS has been getting much more complex claims in relation to our operations and how we can help customers the best way we can. So as you can see from this slide, our easier, perhaps more simple claims to pay over the last few years have reduced, while the more complex claims have increased. Now, there's various reasons for that. For one, the PPI, which was, as we know, advertised and sold over the last decade or so, when that was kind of cleared up by the FCA, those particular payments were pretty easy to pay out in terms of who the customer was, how much they were owed. In terms of what we've got now, is that especially in the pension space, so especially self-invested personal pensions that people may decide to withdraw from their DB or fund and fund their own personal scheme. If those have failed, for example, due to bad advice, those are much, much more complex to undertake. And that has an increased cost for FSCS in terms of our day-to-day management, but also increased stress on the consumer and customer. So what we try to do is help them out as best we can, take them through the process on why potentially their claims are a bit more complex than potentially they were a few years ago and what we need. Now, the reasons for that are varied, especially with pension claims. We need up-to-date figures, which potentially may change every few months, especially with gilt rates and things, which we have a rule on in order to pay out our pensions claims, but also in terms of getting information from consultancy practitioners and others in order to get the best information possible in order to pay those customers back. We'll get to a slide later as well, but we'll look at some of the kind of the average customer we get at FSCS and potentially some of the issues they've faced and how we can help them the best we can. As you can see down the slide below, I won't read them out, but there are percentages there on the complexity of our claims and how these particularly have increased over the years. So in the last 2 years, we have investigated about 529 firms and deemed about 397 of them are eligible for FSCS protection. As you can see, when a firm does fail, it needs to be regulated. It needs to have indeed failed and not just, had a complaint with a live complaint against the Financial Ombudsman Service. And they need to have a civil liability against that particular claim, which we'll touch base on in a second, but hence why these things take a bit longer perhaps than people initially realize. I'm going to hand over to my colleague Guy, who will speak about how the levy is raised, obviously impacting yourselves and other MGAA members, and how we utilize that levy in order to protect the customers the best way we can. Guy.
Great, thanks, Josh. Yeah, I mean, the FSCS is funded by a levy on the financial sector. Okay, perfect. Sorry. Yeah, my internet connection is not perfect today. The levy is fundamentally really made up of compensation, with a few adjusting factors that are less significant that come after it. There are the running costs of FSCS, so Josh and my salary, amongst other things. But the general running costs, the rent of our building, the staff that we have, we deduct from the levy what we expect to receive in recoveries during the year, and there's a true up each year for any sort of unders and overs that may exist in terms of opening and closing balances. But as you can see in the text below, well, I mean, the unders and overs in the last year or two have been quite significant, because we have ended up paying out less in advice claims in particular, and also to a degree in insurance claims than we had thought at the start of the year. But the main part of the levy is the compensation, which is due to customers of firms that have failed. If we go on to the next slide. So the levy is, and I mean, we will make the slides available to you afterwards. I'm aware that the writing is terribly small on these, but the levy is split into a number of classes, so that each firm is paying really for the failures that occur as closely as possible with firms that are writing the same sort of business that it is. So, I mean, the largest levy limit is for the deposit-taking class, being banks, building societies and credit unions, who can be liable to pay up to £1.5 billion a year, although that has never been reached. The general insurance class is liable for 600 million a year. Again, that has never been reached. And the life insurance class, where I don't think we've really had any failures in sort of recent memory. You probably have to go back to Equitable Life, which never actually formally failed. but the life insurance class is liable for up to £690 million a year. There are then the FCA regulated firms. The largest liability within that is general insurance distribution. And I think that the levy that has fallen on them in recent years, as Josh said, since PII has fallen away, PPI has fallen away. Those levies have decreased, although that class is liable to contribute to the retail pool. So that if one of the classes within that pool exceeds its limit on the levy, then the other classes are required to chip in and sort of top up for the payments, and that hasn't happened for the last couple of years, but it has happened in the recent past, particularly around investment and advice claims, where we've seen quite a lot of, as Josh alluded to, sort of pension advice mis-selling claims that are complex and frankly expensive. I think probably the best known of that is what happened with the British Steel pension scheme, where a lot of people were given the opportunity to transfer out of a defined benefit scheme at relatively short notice. Some of them got what turned out to be substandard advice. I think there's a spectrum of what happened there, from incompetence through to downright malpractice, and some of those people have been entitled to compensation. Can we have the next slide, please? So this is looking at what we've paid out in compensation over the last 10 years. I suspect that the orange bar will be of most interest to participants on this call, being the sort of general insurance provision claims. I mean, we have got a couple of general insurers that failed sort of back in the sort of legacy period of the late 90s and early 2000s. So Builders Accident and Chester Street, that are still producing the sort of asbestos and pollution type claims that are going to come through probably for a number of years yet to come. More recently, we've seen a number of smaller insurer failures coming through, who've tended to write niche business. So there's been a fair degree of mini-cab insurance, there's been a fair degree of solicitors' professional indemnity. And I think they've all gone into those markets thinking that they've got some magic formula and they're going to be able to capture the market in a way that no one else has. And they have been wrong about that, unfortunately. But then, in the other bars, I mean, the green bar in particular, you'll see the investment advice business has produced quite significant claims. I think what's probably notable, given what FSCS is best known for, being the depositor protection, is how little we've actually paid out on bank and building society failures in the last 10 years. Because there really hasn't been anything of any substance. I mean, we came very close last year with Silicon Valley Bank, but HSBC happily bought it for £1 in the early hours of Monday morning, so that didn't actually fall to us. But if we go on to the next slide, you'll see a bit more of the history, and I'm sorry the colours don't correspond slide to slide, but what is noticeable here is the black bar down at the bottom, which corresponds to what we've had to levy for the deposits industry. And that reflects the overhang of 2008, when we were called upon to bail out the customers of Bradford and Bingley and a number of Icelandic banks that had UK operations, notably Landsbanki, who operated under the IceSave brand, and Captain Singer and Friedlander, who had an online UK deposits operation. There's a couple of smaller operations in there as well, but we borrowed just shy of £21 billion from the Treasury in 2008. That has been repaid with interest, and the black bar is essentially showing the interest that we were levying on the banking industry until we managed to finally repay it all. I think at the start of 2019, the last of it went back, but there was a recoveries effort over the sort of 10 years that period extended to, including working with the Treasury because Bradford and Bingley have been nationalised as part of the failure. The deposits book was transferred to what was then Abbey National, now part of Santander, but that transfer was funded by FSCS, who advanced £15.7 billion to cover off those deposits, which we then subsequently got back from Bradford and Bingley as a result of them selling off some of their loan book. So the recoveries road can be sort of long and fiddly, I think it's probably fair to say. And 5 to 10 year horizon is not unknown. But yeah, I think that's probably the key point I wanted from that. So if we move on. As I mentioned, we also have to levy for our management expenses, which are sort of close to £100 million a year. It's the running costs of FSCS. It's about the claims handling. It's about all the stuff that goes on in the background. It includes about £7 million for the cost of our financing arrangements. So we've got a loan facility which is available to us should we need to fund a new failure that comes along. I think that's particularly relevant in the deposits space, where we're expected to pay out within 7 days. And I think there's also there's a bill going through Parliament at the moment which will potentially make us liable to contribute to recapitalising a failing institution so that it can be still going on the Monday morning, and that would require us to have money at very short notice, and we have a £1.45 billion loan facility in place to facilitate that. It's available across all classes of failures, but it's principally there for deposits. But obviously, having £1.45 billion available pretty much on demand does come at a cost. So that is a factor within those costs. And if we go on to the next slide. So this shows you the recoveries over the last 10 years. It splits out the banking failures because they so ridiculously skew everything else that happens, and even within themselves they're quite skewed, because in the chart at the bottom, from Bingley, when it sold off lumps of its mortgage book and repaid us the money that was due to us under the legislation that resolved it. Smaller bars that still amount to hundreds of millions of pounds, which reflect money that came back from Landsbanki and from Calpthing, as we participated in the insolvency processes of those. I think up at the top you've got the more sort of mainstream stuff that's happened happened, and I think what it probably shows is that the recoveries business is quite lumpy and tied to individual failures. So, in the insurance space in 2017-18, you've got a very big bar there, which is almost all made up of a recovery from independent insurance, which failed in 2001 on the back of a fraud. The chief executive went to jail. I suspect we probably got our recovery after he got let out. But independent cost us something like £500 million in claims. We got 80 or 90 million back from memory. But that all came in one lump at the end of the process. I think we're now seeing more, and what we've seen in 23-24 is people starting to pay interim dividends, and hopefully those will flow through as claims are agreed on insurance cases, and that will provide more of a steady income that will be available to offset the levy. So that's that. And then we've got our funding arrangements. I mean, I touched on the revolving credit facility in talking about our management costs. I mean, in general, we will hope and expect to fund ourselves, and I think this has been the case for the insurance industry for a number of years, through normal cash reserves and the annual levy. And insurance happily is more predictable in terms of what is likely to go out of the door. So the levy will normally cover what we need to raise in any one year. We do have the ability to come back to the industry midway through the year and raise an additional supplementary levy. We're very aware that that's very unwelcome, because people have annual planning cycles and they want to factor in what they're going to expect to pay for the levy. And I think we've recognised, certainly in the 10 years I've been at FSCS, we've recognised that a lot of people are working on December year ends, and our original practice of publishing an estimated levy in January wasn't terribly helpful to a lot of people's budget cycles. So we now try and put something out in late October, early November. So hopefully it gives people a bit more chance to factor into their budget what we might be expecting to ask you for over the coming year. We have an overdraft facility that we can dip into if we need to. I think it's fair to say we very rarely use that. We have the revolving credit facility, which as I say, is principally there about banking failures. I can't see that an insurance failure would readily require us to sort of need money that we couldn't raise within the levy cycle. But never say never. It might happen, and some of the recent changes to the law, section 377A of FSMA, which allows for the PRA to write down insurance liabilities, could trigger a need for money more quickly from an insurance failure. And then, as an absolute last resort, we can go to the Treasury, as we did in 2008. I don't think anyone wants to see that happen again, and I think we don't want to see that happen again. It's politically unhelpful. I think Josh will probably understand that much better than I do. But it doesn't look good for us to be borrowing public money to bail out a financial services institution. So I think there's probably enough mitigation in place that we hope it won't happen again.
Great.
Thank you. And then if we go on.
Yep. It's my section now, Guy. Thank you for that. Guy's going to come back, everyone, for section 4, which we'll get into later on. But I thought what we'd do now, as Guy's helpfully explained how FSCS raises money and pays out that money, especially on those graphs we saw about how much money we've raised per class versus how much we paid out. I thought it'd be helpful that we can have a quick look at how we look at the claims journey. So when someone approaches FSCS for a claim, now claims kind of work in a few ways for deposit takers. So that is if a bank or building society, credit union has failed. FSCS has a separate mechanism for that, whereby we can pay out the compensation within, our aim is within 7 days, with no one doing any proactive claims to FSCS. So we'll do that automatically for you on your behalf if your deposit taker were to fail, for example, and we get you your money within 7 days. You don't have to worry, you can sit back and relax. For everything else, people will have to make a proactive claim to FSCS and provide relevant information on perhaps why they've lost money and if their particular person they've invested with has indeed failed. Now, probably everyone understands, probably more well known, what happened in probably sections 2 and 3, but probably what is less well known, perhaps amongst colleagues here or others, is what we do to prepare for potential failure, the finance of that failure, which Guy has touched on, and post that failure, for example. So what we do at FSCS, we'll work really closely with our colleagues at the FCA, for example, or the PRA, or doing our own work. And we kind of have a bit of a horizon scan or a watch list, potentially what's going to come down the track in this year or future years, just keeping an eye on that so we can prepare a levy for that for the following financial year if that's what we're going to plan for. And we do that through forecasting, we do that through research, we do that through different pieces of information from various sources in order to make that as best as possible. We also then obviously make the claim, have the financer guy covered as well. But then we kind of do this a bit of a post-claim and future, saying what has worked and what hasn't worked. So we work really closely in terms of policy with the bank or the Treasury. As Guy mentioned, there's a bill going through Parliament at the moment to give more kind of authority to FSCS to ensure that it can protect against a bank failure. And that was in response to SVB. So basically, in a nutshell, it gives authority for the Bank of England using FSCS levy funds to either recapitalize a bank or create a bridging bank. So if anyone in a small bank potentially may fail, it will be protected from that particular element. So we were working closely with the Treasury on that for about a year. But we also helped Treasury on the Financial Services and Markets Act, which got passed last year, which is a reform to the FS sector, as we all know. Had some slight amendments to FSCS there, but also working really closely with the FCA, PRA and others, especially around rule changes as well. And what we've also done in the past is looking at claims and who is coming for those claims. Is there a bit of a theme running, especially with some of the firms that have failed? So previous years, we have looked at preventing consumer harm. And this includes things such as phoenixing. Now, phoenixing is a process which people know on the call where an organization has failed and the directors deliberately set up a new company without any kind of debt from the previous company and kind of do the same thing they've done previously. And that is in terms of targeting the same customers, making the same mistakes again, but ensuring that they don't really have any liability themselves. So we try to track that as best we can, saying how many of these same firms have the same people directing them, and is there a theme with that? Some, of course, are just a mistake. It happens. Capitalism, things don't always work out. But for others, is there a bit more of a sinister motive behind the scenes? One example that we had with the successful phoenixing case was against Harlequin, which was an organization that did fail, and we worked with the Serious Fraud Office with them to ensure that the particular directors didn't have access going forward anymore. So, you know, that was something positive that FSC has done proactively. Instead of just paying claims, we are trying to reduce claims as much as possible and failures within the system as a whole. This is, as I said, I won't cover this as the pre-watch list, as I said. You know, we talked to the our colleagues in the PRA and the FCA and the Ombudsman as well, in case they're paying out claims on an organisation that is still live, but doesn't potentially look at that organisation will be live for much longer given their civil liabilities, and working with them to ensure that that FSCS knows about that in case these things happen. And as you can see in terms of the fail rate here, how we look at emerging issues. As I said, we've covered that already. There's a watch list, default imminent statements, etc. So we won't go into that. I thought what may be useful though, and after covering kind of how we do things, is what we've done in the last 12 months. And I think it's a really good impact on the work of FSCS, kind of what we do, protecting customers, but also ensuring that those people who have unfortunately had a failure that they've invested in do have confidence in the financial services sector, so they're not left high and dry due to either bad advice or a firm that has just gone bust. We don't cover for everything, of course. As I said at the start, we only cover what Parliament has told us to cover with the rules made by the FCA and the PRA. So we don't cover things like crypto, for example. We don't cover things like peer-to-peer lending, things like that, that other people may do it. We also don't cover things like if your share price has suddenly collapsed and fallen. So that's something that we don't do. All we can cover is regulated advice that has gone wrong, etc. But as you can see here, last year, this is up to the financial year of 2024. We paid out about £423 million of claims. There's about 41,000 firms in the UK, of which in the last 12 months, 447 failed, which FSCS stepped in to protect. And we protected 19,000 people. So those 19,000 people could have confidence and reinvest, which many of them do, back into the financial services system for various reasons. We made quite a good recovery process last year. We got £54 million back from failed firms back into the FSCS pot, reducing the levy, reducing the cost to MGA members and others that have to pay into the levy, ensuring that they get the best deal possible that we can. And I thought the screen is good as well because it kind of covers a view on kind of what the average FSCS customer is and how we can help them the best as possible, kind of doing a bit more research into that. So as you can see, most are from England. It doesn't surprise, kind of matches where the population is really. Most are male customers who have faced financial hardship for various reasons, between a salary of 10 to 40k, so not particularly wealthy people. They're not high net worth individuals. They're not paying the 40% tax rate. They are on the average salary for the most part, and trying to do the best with their money as well. And as you can see, most live in Southeast England as well. So we kind of cover that as well. So we can kind of break it down per constituency as well. So when we meet with MPs, we can inform them of how many of their constituents may be affected, or kind of where kind of the investment is going as well. Post-claim, I'll touch base on this quickly before I'll bring back Guy in for the final part, which is about recoveries. So as I said, one of our statutory functions is to have a post-claim and how we kind of do that. That's in the FSCS rules that the FCA have made for us, something that's cost-effective, etc., etc. So Guy will go into further detail shortly, kind of how this all works day to day. And then in terms of our external work as well, which is one of the portfolios I lead on. So as I mentioned, we work really, really closely. We're not just in our kind of little bubble. We work closely with the FCA, PRA. We meet with all our trade association members, such as the MGAA. I know our CEO, Martin, has met with Michael frequently as well. We went to the MGA conference. I attended the MGA conference earlier this year in the summer by the river there, which was a very hot day as far as I recall. But it was great just to kind of hear from industry, hear from members, hear what the kind of the latest are on the ground as well. And as I said, we work with a range of departments, Treasury Department for Work and Pensions, especially looking at the pension space, parliamentarians, select committee or peers. As FSCS is a public organisation that is established by Parliament, we do have certain accountability and scrutiny mechanisms in place. So we are scrutinized by the FCA and the PRA in the first instance, and if not, we have to appear in front of the Treasury Select Committee or the Lords Financial Regulatory Committee on occasion for various reasons. That's their role to do that. FSCS does use public money effectively to pay the claims, and how we can be the best responsible we can. So our senior team will appear in front of Parliament if and when necessary as well. We've got a few mentions of Parliament. That should say 2023. Apologies. There's a slight typo there. But as I said, since we've got a bill going through at the moment in Parliament, there's a lot more mentions of FSCS day to day as well. So we're always in contact with our external partners, getting ideas, getting views, sharing policy suggestions with each other. So I think that's also a really positive thing that we do as an organization. And if you've got any ideas yourself, do just drop us a line on the details that we've got at the end. And Guy, last one to you.
Thank you. I thought this slide would, again, apologies, it's very small writing. I thought it would be probably relevant more to MGAA members because it looks at the insurance failures that have happened. And I'm sorry, it's been taken from an earlier pack. It only goes up to October 22, but I don't think anything has happened since then. So I don't think we've updated it since. But there have been a sort of a handful. I think we probably see 1 to 2 insurance failures in a typical year, which will generally be writing a fairly niche area of business, they will produce a reasonable number of claims. I think each one is probably expected to produce sort of tens, if not 100 million of claims. So it's probably as well that we don't have more than 1 to 2 failures a year. I think the levy on the general insurance industry has been in the region of 150 to 200 million pounds a year for, well, as long as I can remember, really. It tends to be a mixture of legacy claims from principally Builders Accident and Chester Street, as I mentioned earlier, but then also you get the more recent claims coming through. So if you go back to the start of that slide, Enterprise in Gibraltar is still producing claims. It had quite a large motor book from memory, and motor books play out in the large part over a relatively short term, as I'm sure you'll all know. But then there are the more serious claims that play out over a longer period. And right up at the other end of that spectrum, MCE in Gibraltar, now I think known as Green Returns 123 Limited, has again got a motor book in it, and that will continue to produce claims for a number of years. I think MCE more helpfully has declared a 30% interim dividend. So in an attempt to reduce the levy, we're now in an agreement with the administrators of that firm that we will update our claim every 6 months, and they will give us that 30% on account, hopefully increasing as time comes through, so that we've got a stream of income that's coming back from that insurer. Because I think one of the features of the recoveries market, if you want to call it that, is that each recovery is dependent on the nature of the firm that's failed. So a fair bit of what we've talked about is in the investment space, where there may just be outright frauds, where there's actually not very much to get back. That tends not to be the case in the insurance industry. And you've generally got companies which have got some cash reserves. I mean, as you all know, insurers have the benefit of getting the premium up front and then paying the claims out later, which hopefully are less than the premiums that were taken in. So if there is a reserve of cash and investments, which you'd normally expect to see, then there should be something that can be recovered from an insurance firm. And also, obviously, there will generally be a book of reinsurance that we would hope would respond, and we would work closely with the insolvency practitioner so that they and their team could talk to the reinsurance book and get back what they can from that. I think I wanted to touch briefly on one point that Josh made on preventing failures, and us talking to the Serious Fraud Office about Harlequin. Dave Ames is doing 10 years at the moment, so I think that has been quite preventative as an action, and we certainly did work with them on that. Dave Ames being the man who ran I think several £100 million property fraud scheme, which enticed people to invest in properties in the Caribbean that by and large didn't get built. So I think that probably again goes to the differences in cases where you may have an insurance firm where someone has sort of got ahead of themselves and been over enthusiastic and done something that isn't going to work out, but done it with good intentions, and there probably is something to come back from that. And then on the other hand, you do get, unfortunately, out and out investment frauds where someone is just pocketing the money, and that is much harder to get back, but we do try. And yeah, you can see, our key sort of recoveries failures. I think we got back, I said earlier, I think we borrowed just shy of £21 billion from the Treasury for the 2008 bank failures. We got 20 billion of that back, so we actually only had to levy the banking industry £900 million, which is still an awful lot of money, but at least 95% of that money did come back in capital terms from recoveries. There was an interest bill to Treasury on top of that, so the taxpayer wasn't out of pocket as a result of any of the FSCS interventions in 2008. And more relevant to insurers, we have got about £53 million in the last 5 years from insurance failures, which has all gone to offset the levy. So yeah, we don't levy you unless we have to, I guess is the message.
Great.
And I think that's probably it.
That's it. Thank you, Guy, and thank you everyone who joined. As I said, the learning objectives are just here again. Hopefully you've got some of that under your belt now. We will share the slides via Julia to you or others watching later on. But we're really happy to take any questions now, as Julia mentioned at the start, and answer those as best as possible. Julia, I hand over to you.
Thank you, Josh, very much indeed, and Guy, that's really helpful. Great set of slides. I know, Guy, you were saying the text is a little small, but I think it's always a balancing act between having the information you can disseminate post-briefing versus just having pictures and talking around them. So that was actually absolutely fine. We haven't got any questions in the chat at the moment, but I've actually got a couple myself.
Of course.
You mentioned about the watch list, and I don't doubt for a second that you are unable to tell us who's on the watch list, but is there anything you can tell us, even if it's kind of the theme of what you are looking at the moment?
Shall I say? I mean, yes, clearly we can't tell you who's on the watch list.
Of course.
I think it's really tricky because one of the figures that was on one of Josh's slides earlier, I think there's 40-something thousand regulated firms, and I think that it will probably be a handful that actually causes a lot of claims in the next year. And trying to pick up, because again, I think one of Josh's slides said we paid out on something like 500 firms in the last year. Well, actually, probably over half of the compensation that we've paid out will relate to 20 firms. and trying to pick the 20 out of the 40,000 is almost impossible. So I think, yes, we do have, the FCA, the PRA have watch lists, but they're actually really hard to put together, because you just don't know. If someone is out, if you can see someone who's got a business model that is obviously going to go wrong, that's fine. You can get them on the watch list and you can prepare for that and or stop them doing something completely mad. But if you've got someone out there sort of with nefarious intent, if I can put it like that, it's really hard to pick that up in a population of 40,000 firms.
Okay, thank you for that. It was worth asking on behalf of our members. And the slide that showed the failures since 2016, I mean, it is glaring that it's, in 6 years, there's 7 in the territory of Gibraltar. What's your stance and what can you share on that rather unsatisfying statistic?
Yes, I think Josh and I spoke about this beforehand, and we're not allowed to say we should give it back to Spain. It's very difficult. I mean, we do have quite regular liaison with the Gibraltar regulator, the GFSC. I don't think they want there to be the failures in Gibraltar, and it's also it is probably worth saying that there's a number of sort of large and reputable UK firms who have operations in Gibraltar and contribute substantially to the levy. So I got asked this question a couple of years ago and was slightly horrified by it because I couldn't think of a sensible answer. But Gibraltar firms pay more than you might think towards the general insurance levy. So it's not as bad as it looks, but it's difficult. It's an independent market. The UK government can't directly, well, the UK government probably doesn't have the appetite to directly control everything that goes on in Gibraltar. And I think it would be politically very difficult to try and do that. But we talk to the GFSC regularly and let them know what's happening. And I think that they have an interest in being seen as a well-regulated and competent market. And I know that, the administration in Gibraltar wants that to be seen to be the case. I mean, you'll be as aware as we are that they come over and market on a fairly regular basis as to, what a sensible jurisdiction they are.
Yes.
So I think they do have an interest in trying to keep things under control, but yes, it is just undeniably unfortunate that the number of times that Gibraltar appears on that slide.
We don't have any more questions, so I think unless any of our delegates suddenly think of something they want to quickly drop into the chat in the next moment or two, I would like to say that the MGAA and our members do really appreciate you taking the time to come and speak to us. We always like to know as an association that, what our members think and what they know about various trade bodies, government bodies, etc. is important to them. And as I say, by virtue of the fact that the FSCS is always in touch with the MGAA, looking to either share, future strategy, financials, and a presentation such as this, as I say, it is well received. So we do thank you both, Josh and Guy, for that. For delegates, we have a comment, very interesting session. Many thanks for providing the talk. So that's very kind of you. That was James. Thank you very much. So to our delegates, thank you for joining us today. Do please, when you see the feedback survey, just take a moment or two to complete that, because it really is important to us that we are delivering the right briefings to our members. And if anybody on the call is a claims professional, please bear in mind that we have the MGA Claims Conference on the 7th of November 2024. So if you find that's of interest, do head to the MGAA website where you'll find further details. So thank you very much again to Josh, Guy and FSCS, and thank you to our delegates. Have a great afternoon.